Hello, my name is Chuck Youree. I'm founder of Main Street Investors. Today I want to talk about one of the investment myths, and that is market timing. Does market timing work? What is market timing? Market timing is going to cash when you think things are going to be bad in the future, or being all in when you think things are going to be good in the future in the stock market. That means you got to know the future. That means you have to be able to predict. That means you have to have a crystal ball. So let's look at historically, let's look at some of the things. Let's look at the dot-com crash in 2000. In 1999, the NASDAQ, which have all the tech stocks, was 85% up for the year. So everybody was pouring money in. Fund managers, individuals, they were all in. This was the greatest thing in the world. And then it crashed. They lost 70% or more of their money in the NASDAQ itself. So, did they see it coming? No. What happened after that? Well, for 10 years, the S&P 500 was flat after that. And the NASDAQ was still not up to where it was. So, it didn't recover. So both were down. And think about this too. In 2020, with the pandemic, what happened? It crashed. What did people do? They tried to time it. They got scared. How much money came out of the market in the spring of 2020, which is this year? Try $1.3 trillion. Did they get back in and ride back up? Because you know that's what it did. No. Fear. Fear came into play. So you can be scared and market timing comes into play, or you can be euphoria and be all excited and put all kinds of money in. So it doesn't work, because you have to be able to tell the future, and that can't be done. So, what are you going to do? What's the solution? Okay, well, first off, we do want to invest in stocks. Now, you don't have to be 100% in stocks. You can have a portion of it in bonds, and we'll talk about that. But so we have a 60-40. What about a 60 in stocks and 40 in bonds? So we look at that. So we want to mitigate risk, so we diversify. We don't have all our money in the S&P 500 or tech stocks. In fact, we don't have all our money in the U.S. We want to be globally diversified. We want to talk about rebalance. What is rebalancing? Well, rebalancing is, remember we said if you had 60% in equities and 40% in bonds, and what happened in this year, 2020, when the market fell off in the spring? Well, the rebalancing is the 60-40, the 60 went down. So we had to take some of the money from the bonds to get it back up to 60-40 at the end of the quarter. Well, we ended up buying low and selling high. And it's done automatically. As an investor, you don't have to do it yourself. Thanks so much.